Diversification is extremely important, and don't ever let anybody tell you that you shouldn't diversify. You should definitely own at least 8 or 9 stocks or more. Owning just say 3 or 4 stocks is very risky because if something bad happens to one company that you own, it could really bring down your returns. Now, sure, it's great to have 100% of your money in a stock that doubles, but it's also not so great if you have 100% of your money in a stock that collapses in a day. And this can happen. Many people don't think that a stock could collapse 90% in a day, but it has happened. This chart you're looking at here is for GT Advanced Technologies, and this is just recently. And what happened is everybody thought that, they were Apple's supplier for these sapphire crystal screens on the phones, and everyone thought the new iPhone was gonna, use these sapphire screens. So what happens is that all of the future cash that this company was supposed to make was already priced into the stock. And then when the news hit that Apple was not using this supplier, they were not going with the sapphire crystal screens, the stock collapsed over 90% in one day. Okay, and this wasn't some penny stock. This was a stock trading near $20 a share on the exchanges, the Nasdaq. I mean, this was a pretty popular stock, and it collapsed 90% in one day. And there was a whole write-up. This guy that owned shares, he wrote a letter to a judge saying that most of his retirement income is gone because he put most of his retirement income in this one stock. So this guy who did this was extremely foolish. I mean, this is just something you do not do. But a lot of times people have this gambling tendency to bet the farm on stocks. People have done it with these leveraged ETFs, which is just crazy. You shouldn't even own those things, and it's just silly. So you should always diversify. And now, a company like GT Advanced Technologies, this is a company that I would never recommend. I would never own. I don't really own any technology stocks for this reason. There's too much competition. And the number one thing you should always look out for, never buy a company who only relies on 1 or 2 customers. That's one of the worst things you could do, because if those customers go away, 50% or 100% of your revenue will disappear. So this is one of the most important things to know with business. Never buy a product that relies on one customer. All the companies that I recommend, they have multiple customers, thousands of customers in multiple different countries. So not only are you insulated from, one supplier, that risk, you have, there's many people are buying your product, but many countries and many currencies are purchasing your product. So even if one currency in one country goes down a lot or collapses or something happens in that country, you are insulated. That's why it's very important to own global companies. So be very careful. If you look at this chart of this stock, it's just startling. It's really startling, and it can happen. And even if you only have 10% of your portfolio in a stock like this and it goes down 90%, your portfolio will pretty much take a 10% hit. But a 10% hit is something you could deal with. That's okay. You could always fix a 10% decline. You could build back up. You can make the returns over the next few years, and you'll be okay. It's not going to change your lifestyle. But if you lose 70 or 80% in your portfolio, a lot of times you can't really come back from that. It's very tough. It's demoralizing. People end up giving up investing. So diversification is key. My thing, like I said, own at least 10 stocks or more. If you only have a really small amount to invest, like say $10,000, personally, you should probably just own a mutual fund, a mutual index fund. Own a mid-cap index fund. Mid-cap index funds usually have better returns than, say, an S&P 500 index fund. They own more mid-cap companies, which usually have better growth, whereas the S&P 500, you're going to get a lot of these large behemoth stocks that really aren't. It's a tougher time for them to grow. It's not easy because they're so big. So a mid-cap index fund is good. Also, a consumer staples index fund, from Vanguard. All those consumer staple stocks like Clorox, Colgate, these consumer staples mutual funds, they own all of those stocks in one mutual fund. So that's a mutual fund that I really would recommend. And this is if you have less than $10,000 to invest. Now, if you have 50,000, 100,000, a million, $5 million to invest, the more money you have, the more stocks you should own. You shouldn't really concentrate a huge chunk of money in any one stock. So if I was, controlling around $1 million, 15 stocks would probably be good. Anything more than that might be getting a little bit crazy. You really have to keep up with the companies. To keep up with more than 15 or 20 companies might be much. But again, never bet the farm on one company, as you see with this. You'll wake up one day and you could lose all of your money. So just be very careful and do not do it, and make sure you diversify. So short selling is something that I would strongly advocate against, and I will explain the reasons why. First of all, for all of you who do not know what short selling is, it's just the opposite of buying a stock and selling it at a higher price. Short selling is you sell the stock first and you hope to buy it back at a lower price, and you pocket the difference. So if you short sell a stock at $10 a share, and you just do it in your brokerage account, it says sell short, and you sell short the number of shares, and it sells the stock even though you don't own it. It shows up in your account that you sold it, and it'll have like a negative next to the number, just showing that you have to buy back the stock at a later date. Now, if you buy back the stock at a lower price, that's what you want, so you could then pocket the difference. So if you short sell a stock at $10 a share and it goes down to $5, well, you just made a 50% return. Well, what happens is you could lose money. If you short sell a stock at $10 a share and it goes to 20, you're out your whole investment. You're out 100% of your money. So short selling, the problem is the mathematics. On the upside, you could potentially lose an unlimited amount. But on the downside, where you make money, you could only make 100% because a stock could only go to zero. It can't go past zero. So if you short sell $10,000 worth of stock and the stock goes bankrupt, well, the most you can make is $10,000. If you short sell $10,000 worth of stock and you wake up the next morning and the company got bought out and it went from $10 a share to $30 a share, well, now you're out something like 300%. So not only do you lose your $10,000, but you pretty much owe like $20,000 more. So you could lose much more than your original position. Many people will say that there's not only 100% limited money you can make. They make the argument, like Jim Chanos recently wrote an article and he said that, well, this is not true. You can make more than 100%. And the reason is that as the stock keeps going down, you could keep shorting larger and larger amounts. Well, this is nonsense. This is the same thing as saying that as a stock goes up, you keep buying more and more and you can make more money. The whole point is that you're putting more risk and more money on the table, and you're taking much more risk. So again, 100% is the most you can make. Sure, if you put new money, you may make 100% on that new money. But on the old money that you put in the first position, 100% is the most you can make. And the risk reward with short selling is just not really in your favor. So the chart you're looking at here is Sears Holding. And I'll show you the main reason why I do not like shorting stocks. Now, everyone knows Sears is probably going to go bankrupt sooner or later. It's a crap company. Their days are over. I mean, Sears was good in your grandparents' days, but Sears is just no good anymore. They can't compete. If you ever walk into their stores, they're just terrible. It's disgusting. I mean, they have junk. They might be good for a few things here and there to buy, but I mean, no one really shops there. Go into a Sears, and the real estate they own is huge. The amount of rent they're paying must be I don't even know how much it is. They probably own a lot of their real estate too, which is why it's kind of keeping them afloat. But they're just raping shareholders, and it's just like a slow, steady bleed dry of the shareholders. And I just don't think Sears is going to do anything in the future. It's going to slowly go bankrupt. Or maybe they get bought out by some private equity firm to try to turn it around. And that's another real risk too with these companies. So if you short sell a stock like Sears, and short sells have been shorting for a while, you'll see that the stock just zigzags up and down, almost really going nowhere except driving the short sellers crazy. And what happens is when the short sellers, when they buy back their stock at a low price, that's called they're covering their short. So when they cover their position, you'll see you get these massive rallies and the shorts get caught off guard. People who are short the stock, it's called they get run in, and meaning that the stock could easily go up, triple in value. I mean, if you look in the beginning of 2012, Sears Holding was around $20 a share. And many people might think, oh, I'm going to short this stock, it's going bankrupt. Well, a few months later, it was at $60 a share. So you have a 300% loss. So short selling is extremely risky. I would not do it. To me, there's really nothing in it for me. I mean, my idea of making money in the stock market is, buying a stock at, say, $30 or $40 a share and then having it go to $300 a share. That's the real way to make money. When you short sell, I mean, you could really only make these little 20 or 30% gains, and you quickly got to cover your short. You'll have a short-term capital gains rate because you're probably not holding the short position longer than a year. So it just, the economics of short selling is not good. And most of these crappy companies, they do this. They don't go down for many years. And short sellers continually short the stock and then end up having to buy it back at a higher price. And everything's zigzagging all over the place. I mean, this is not investing. This investing is about buying a business and owning the future cash flows. Short selling is all about speculation. You never know what management's going to do. And you could be short a company. And a lot of these companies that are kind of crappy companies, hedge funds and private equity funds, they swarm these companies. They try to get in and take large positions and change up management and turn the companies around. So a lot of these are potential turnaround candidates. So you don't want to be caught shorting a stock that's a potential turnaround candidate. And now here you are shorting it at the bottom. That's not something you want to do. So, even these companies that people know for sure that are going bankrupt, like a lot of these Chinese fraud, these small cap Chinese stocks, that there's that website, Muddy Waters, that shows all the Chinese frauds, and they have a pretty good track record. But the problem is a lot of people short these Chinese frauds, and then the companies go up like 200-300%. They eventually do go bankrupt. The problem is that it's like getting run over by a train, and then the train derails, 100 feet later. Well, yeah, you could have been saved if the train derailed, before it hit you, but the bottom line is that you got hit already, and then the train derailed. So it's the same thing with short selling. A lot of times, they have these massive rallies, and the short sellers lose a bundle, and then after all the short sellers lose most of their money, then the company usually goes bankrupt. So stay away from short selling. It's just not good. Look, you could try it and try to reinvent the wheel, but you'll probably get run in a bunch of times, lose money, and then realize that short selling is definitely not the right thing to do. So, like I said, I don't short sell. You guys could do what you want, but it's not worth it. So now I'm going to go off the subject a little of investing, because the bottom line is that you can't invest if you have no money to invest, okay? It's all about saving money and building up money so you can invest. Now, there's a lot of people out there that don't have any money to invest because they have huge car payments, huge mortgage payments, and they actually have huge insurance payments that they don't need to have. So I'm going to talk about quickly insurance and what type of insurance is probably good for you. Now, everybody has a different family situation, so I can't come on here and say that you should only buy term or only buy whole life insurance. Okay, I can't do that. You have to see your own insurance broker or a financial planner that you use, because I'm not going to give personalized investment advice here. But I will just tell you from what I've seen and all of the books I've read on insurance, what the right way to go about this is. And the right way seems to be, and what I use, is just to buy term insurance. A lot of whole life insurance is a scam, but what term insurance is you're just buying life insurance for a specific term, say 20-year term. And the whole point of life insurance is to make sure your life is insured if you are the main breadwinner in your family. If you're the one that takes home all the income and something happens to you, you want to make sure you have enough money so that your family can pay off the mortgage, isn't out on the streets, maybe some of the kids' college is taken care of, okay? But that's what really life insurance is supposed to be. Life insurance is not supposed to be a product you should have when you're in your 60s or 70s and you have grown kids and there's not really any, there's no income you're replacing. By then, you should have sufficient assets that you don't need life insurance, so that if you die and something happens to you, well, you already have sufficient assets and your wife will be fine. You have investments, you have a paid off house, and there's no need for insurance. And this is why term insurance is the best, because term insurance is cheap. You could get insurance for pretty much, $20, $30 a month if you're healthy, maybe $40 a month, but it's cheap and you could get covered for, $500,000 or more. And that's what you should be doing, because it doesn't really take up any of your cash flow. Spending $10 a week on term insurance is really nothing. Now, a lot of people will try to sell you whole life insurance. Why? The reason you'll see many people, and you'll see mostly friends that are coming to you trying to sell you whole life policies, is because the commission is huge. The commission is really nothing on a term policy. On a whole life policy, they get pretty much 100% commission. So if they sell you a whole life policy that costs you $3,000 or $4,000 per year, their commission is $4,000. And then it's even better if they sell whole life policies for your kids, which is a shame that people do this, because you don't have to insure your kids. You're not replacing an income. It's a shame if they die, your kids, but if your 5-year-old son or daughter dies, you're not financially, you're not worse off. So it's so silly, and it's such a shame that these insurance brokers try to sell people whole life insurance. So basically what whole life insurance is that you're building up a cash value, and it's a scam because they say that you could borrow off of the cash value. What they don't tell you is that the death benefit is paid. They pay you your death benefit when you die with your cash value. So it's not like you get this $1 million or $2 million whole life policy. You built up a cash value your whole life, and then all of a sudden you die, and then you get this huge $1 million payoff for your family, and all that cash value is yours. That's not true. The cash value is what's used to pay your death benefit. Now, also, the returns, they say that whole life policies pay a dividend, okay? The dividend is never paid out what they say, okay? And the only way that whole life insurance really sometimes could work okay is if you hold the policy for about 35 years or more. Once it gets past like year 30 or 35, then it could work out okay. But the thing is, all the research shows nobody holds their policies that long. Why? Because a whole life policy is extremely expensive. People are spending $500, $600, $700, $800 a month or more on their whole life policy. It's disgusting. You could get the same insurance amount for $10 a week instead of $200 a week. So a lot of people, the reason why they can't invest in the stock market is because all of their money is going towards paying these stupid whole life insurance policies. There's no need for it, okay? So anytime you see somebody selling you insurance that is trying to peddle you whole life insurance, about the only reason why whole life insurance should be used if you have specific estate planning things going on, where you have like a $10 million estate and you don't want to get hit with huge estate taxes, and you set up a whole life insurance policy. Totally different thing with that. That's a totally different. That's in the realm of estate planning, and that's whole life insurance policy is only supposed to be used for extremely wealthy people. But for the average Jane and Joe, and even upper middle class people, shouldn't be using whole life policies. You should just be using term life insurance. Many brokers will try to scare you. They'll try to tell you that, oh, but what happens if you die and you're older or whatever? The bottom line is, when you're older, you're supposed to have sufficient assets, okay? And if you don't, well, then you shouldn't be investing in a whole life policy, because if you didn't have any assets to begin with, that means you weren't a good saver your whole life. So who's to say that now all of a sudden you're going to save all this huge, large amounts of money into a whole life insurance policy? You're not. You're going to end up doing it and then canceling it. And a lot of times why these brokers call you up like a year or two later and say, hey, listen, we have a new and improved whole life and policy. I have to look at your insurance policies. They're structured all wrong. The reason why brokers say that policies aren't structured right, that they're structured wrong, is because when they institute a new policy, they get that new commission. So they get a whole 100% commission again. So that's why you'll hear insurance brokers say that, oh, whole life insurance is good. It has to be structured right. No, they just do that so then they could look at your policy. They're going to tell you it's structured wrong, even though nothing's wrong with it, and then they're going to get a whole new commission on it. So the whole life insurance policy crap, stay away from it. It's nonsense. Stick with term insurance. You could get term really cheap, and that's all you need. And then once your kids are older, you don't need life insurance. You should have money, whether it be in a 401k or your house is paid off by then, or you have individual stocks that you made money that you invested in throughout the years, and that's it. You don't need life insurance. Don't let anyone tell you that you need life insurance. If you have sufficient assets that if the main breadwinner in the family dies and the other person could get by, don't let them get you into this stuff, because it's just nonsense and it's only fees for the brokers. Stay away from this. I've seen so many people get scammed by the whole life insurance scam, and then they try to get them to buy whole life insurance on their kids, and that's when they really get the commissions, because now if they're getting a $2,000 commission on you and then you have like 2 kids, they're pretty much hitting up a $6,000 commission just from you, and it's just a shame. Stay far away from it. Stick with 20-year term insurance. This is a question I get asked a lot. Should you pay off your mortgage early, or should you invest in stocks? Well, the answer to this is that there is no right answer. It all depends on your skills as an investor. If you're not a good investor and you really do not know anything about investing, but you want to learn and you want to start investing, my advice would be to take maybe 20% of your disposable income and invest it in stocks, and the other 80% just pay down your mortgage early. And as you learn and become a better investor, allocate more money towards investing. The reason is, and it depends what interest rate you have on your mortgage for your home. So if your home interest rate is 6 or 7%, you got to pay off your mortgage. I mean, because are you going to get a 6 or 7% risk-free return in the stock market? No. But many people's mortgage interest rates today are in the 3 or 4% range. And once you account for the mortgage interest tax deduction, if you're paying a 4% mortgage, you're really only paying pretty much like a 3% mortgage or a 2.8% mortgage after you factor in the mortgage interest rate tax deduction. So you have to say to yourself, well, I could invest in the stock market and over the long term make 7, 8, or 9%, or I could pay off my house early and get a risk-free return of 3%. Now, the other question I tell people is this: would you ever borrow money to invest in the stock market? And pretty much 100% of the people that you say that to, they'll say, no, never. I would never borrow money to invest in the stock market. Well, in essence, if you're not paying off your mortgage early, that's what you're doing. You're basically borrowing money and investing in the stock market. Because what happens is when you pay off your mortgage, you're getting, if your mortgage interest rate is 4%, you're getting a risk-free 4% return on your money, or about 3% on your money. But it's risk-free. There's no volatility, and you never have to worry about taking a loss. So it depends. How much should the stock market be returning to you to make that risk that you're taking in the stock market, to have it worth taking instead of paying off the mortgage? There's really no number. Everyone's risk profile is different, and there's really no number. What I do, my house is almost paid off, so I'm not really worried about that. All the money I've made in the stock market, a lot of times I took gains and I funneled it into extra mortgage payments over the years. So I pretty much almost, don't have a mortgage anymore. It's not really a big deal. It's like a very small amount. And the interest rate, my interest rate's, pretty low, and I don't really deal with it. It's not a big deal. But for people that are just buying homes and they have a large mortgage payment, This is something you have to think about. If you're really not the best investor, I would pay off your mortgage early. And then once your mortgage is paid off early, then you could invest in the stock market. But at least knowing that you have a paid off house, you never have to really worry about if you take a loss in the stock market, it's not going to change your lifestyle. You still have a paid off house, you still have a place to live in. So, like I said, this is a personal decision, but just understand that the stock market is volatile, and the risk you take by putting money in the stock market, that risk, the stock market should reward you with a premium return much more than what your mortgage rate is. Okay, so if your mortgage rate is 4 or 5%, and the stock market historically only returns 7 or 8%, well, I don't really think that it's worth investing in stocks. Then you might have to pay off your home early. That might be the best thing for you. Me, on the other hand, over the past 16 years, my compounded rates of return are much higher. They're north of 18 and 19% compounded, just because I've been investing for a long time, and I really devote my life to investing, and this is what I do. Well, then it doesn't really make sense for me to pay off my mortgage so much early. But the thing is that I did. When I made those returns, some years I've had 40% return years. Some years I've lost 5 or 6%. But I remember one year I made about 45% in the market, and I specifically took about half of the gains, and I just made a huge lump sum mortgage payment. And because I said, you know what, these gains could evaporate next year or in 3 years. And I always took gains that I made in the stock market, and I paid off the mortgage. And doing that pretty much has me sitting in the position today where the mortgage is pretty much almost non-existent. There's just a little bit, and I don't really worry about it now. I just leave it. I'll just, I'll pay it off soon. It's not a big deal. But again, this is a personal decision, and it's a decision that I would say for beginning investors, I would say take 80% of your disposable income and pay off the mortgage, and then just take the remainder and invest in the stock market. And until you get a grip of how to invest and you feel comfortable, well, then you could start investing more of your disposable income into the stock market. Well, thank you everybody for purchasing this investment course / video newsletter. Investing is a long journey, and your investment education does not end here. It only begins here. There is no one book, one newsletter that will teach you investing. Investing is a dynamic craft that you will continuously always learn something. Nobody knows. There's no one book that you read and it says, okay, I'm an investor now, I know what to do. And that's not what it is, because a lot of times many people read books, maybe they get newsletters, and at the end of it, they still feel like they just don't have a grasp on investing. And that's what it's supposed to feel like. It's because you can't know everything. That's not the way investing works. Investing is about investing in businesses, and businesses over time always change, and there's always going to be different businesses to invest in. So your education should just begin after this newsletter. Go out and get books on delving into reading company financial balance sheets much more. Learn about different industries. Learn as much as you can about successful investors. Read all of Warren Buffett's letter to shareholders. They are free on his website. There's a wealth of information in those. Read every book you can by Peter Lynch. He was the mutual fund manager of the Magellan Fund, which is one of the best performing mutual funds in history. And I think Peter Lynch's books are probably the best books written on the stock market. They're the best. Specifically, Peter Lynch's book titled One Up on Wall Street. That's probably the best book out there. And there's a lot of other great business books you could read to understand business and what CEOs do to create a shareholder-friendly company. One of the best books to read to learn about what creates a shareholder-friendly company is a book called The Outsiders. Warren Buffett actually recently, a few years ago, recommended it. It's a fabulous book, and it talks about some of the best capital allocators the best CEOs in history. And these aren't the Jack Welches. These are other CEOs that most have never heard of. And it's an incredible book. So pick up that book. It's called The Outsiders. Excellent book. And just keep at it. Investing is something that it takes decades to really get a feel for if you're doing it right or wrong. And when you do it wrong, you can make some really expensive mistakes. So start small and understand that anybody could do it. Okay, and investing is about buying businesses, and it doesn't take a rocket scientist to buy a business. It doesn't. Don't ever let anybody tell you that you're not an investor because you don't have what it takes. Anybody can become an investor. Anybody. So always keep positive in this industry. Don't let people be negative. Okay, and try to be a do-it-yourself investor. It's not going to be for everybody. And if it's not for you, after you've listened to this newsletter and you realize, like, okay, I don't have the time to listen to conference calls, investigate companies by reading balance sheets, reading the annual reports, following the companies, then that's okay. There's nothing wrong with that. And you'll be okay if you just put your money in an index fund. You will be fine. You will probably make more money than 95% of investors out there. But if you do put your money in an index fund, remember, keep it there for the long term and never sell. And that's all I can really say. So I just want to finish off saying thank you to everybody. I really hope you learned a lot. And these newsletters on this website that I know you guys purchased the password, even if the website in a year doesn't exist anymore, these videos are going to be up forever. Okay, you'll get the link that it's on YouTube. There has unlisted videos on YouTube, so they'll always be up. So forever, however long YouTube exists, that's how long these videos will be up. So don't worry if one day you go to visit the website, weeklytelegram.com, and they're not there. Don't worry, the videos they're still going to be up for you forever. They're never going to go away. So with those words, thank you very much, and I hope you all enjoyed this newsletter.